Hello, I'm Guy Thomas. This video is about a concept I call loss coverage, and hence why I think insurance works better with some adverse selection. What do I mean by adverse selection? Well, in general, I mean the point that if you charge a single price for insurance, the same for all risks, then higher risks are more likely to buy compared with lower risks. What I'm looking at in this video is a situation where the government sets rules restricting risk classification, and those rules apply equally for all insurers. Okay, let's get started. The toy model involves two scenarios. In each scenario, there are going to be 8 low risks with a probability of loss, say 0.01, and 2 high risks with a probability of loss, say 0.04. So that's a typical pattern where most risks are fairly standard, but there are a few much higher risks. In this first scenario, there's going to be no adverse selection. Risk classification is allowed, so insurers can charge whatever prices they like. I'm going to ignore all expense and profit loadings just to keep it simple. So on that basis, insurers are going to offer the low risks a true risk premium of 0.01. And at that premium, let's say half the lower risks choose to buy insurance. That 50% take-up reflects the reality of life insurance, but nothing hinges on the precise figure. I could just as well do this with some other figure. In the same way, insurers are going to offer the high risks a fair risk premium of 0.04. And at that premium, let's say exactly half the high risks choose to buy insurance. So that's the same response to a fair premium as for the low risks. We can then calculate the weighted average premium being charged in this market. We don't need it now, but it will be useful for comparison later. So the weighted average premium is just the total premiums being paid divided by 5 persons insured, weighted average premium of 0.016. We can also calculate what I call the loss coverage. This is a new idea, and it's the key concept here. Loss coverage is the expected fraction of the population's losses that is compensated by insurance. From a social viewpoint, that's a measure of how well the insurance system is working. The idea is that the social purpose of insurance is to compensate the population's losses, so if a larger fraction is compensated, that's better. Now in this case, the calculation is easy. Exactly half the high risks are insured and half the low risks are insured. So in expectation, half the population's losses are going to be compensated by insurance. Loss coverage is 50%. To calculate it formally, just take the expected insured losses, divide by the expected population losses. That equals 50% as per the intuition. Now let's move on to scenario 2. At the top half of the page is the same scenario 1 as before. The bottom half of the page, we have the same population, but the government has now restricted risk classification, so insurers have to charge the same pooled premium to high and low risks. That pooled premium is going to seem expensive to low risks and cheap to high risks, so that is going to induce some adverse selection. Let's suppose just 1 low risk now buys compared with 4 previously. And let's suppose that both high risks now buy compared with 1 previously. That change in buying patterns is the dreaded adverse selection. On the basis of that assumed level of adverse selection, we can calculate the pool premium which allows the system to break even. That is the premium which exactly covers the expected losses. So the pool premium we need is just expected insured losses divided by 3 people insured, that's 0.03. So comparing with scenario 1, we now have a higher weighted average premium and a lower number of people insured, 3 people covered by shading compared with 5 people previously. That is adverse selection, and it's usually seen as bad news. But there's something else, and it's something rather surprising. Look at the shaded areas. The shading over 1 high risk has the same area as the shading over 4 low risks. That's because they each correspond to 0.04 units of risk. Those equal areas represent equal quantities of risk transferred. Notice that the total shaded area is actually larger in the second scenario than in the first. That represents more expected losses being compensated by insurance, more risk being voluntarily transferred. That higher volume of trade seems to me a good thing. It's a benefit from adverse selection. The visual intuition that more expected losses are compensated in scenario 2 is confirmed when we calculate the loss coverage. Loss coverage, remember, is the expected fraction of the population's losses that is compensated by insurance. So that's expected insured losses divided by expected population losses. That comes to 56%. That figure of 56% is larger than the 50% scenario 1. So loss coverage is higher with some adverse selection. Now remember that loss coverage is a measure of how well the insurance system is working for society as a whole. Other things equal, more loss coverage is better than less. And so if you accept that measure, you reach the rather surprising conclusion that insurance works better with some adverse selection. Now you may think that conclusion sounds obviously wrong, but if so, I think you need to explain where my arithmetic is wrong. And if you play around with the example, I think you will find that it doesn't depend in any sensitive way on the particular numbers I've chosen. There's no trick in the numbers I've chosen. The point is quite general. Notice that I do say only that insurance works better with some adverse selection, not with any amount of adverse selection. To understand that last point better, please have a look at my next video or Google loss coverage for more papers and books. Thanks for watching.